Morning and welcome everyone. Thank you for joining us on today's webinar. My name's Caroline Brown. I'm the events manager here at UMI, and today I'm joined by my wonderful colleague Roya, who is EM3's Growth Hub Director. Good morning, Roya.
Good morning, Caroline, and good morning, everyone. I thought it'd be useful to give you a little bit of background information on the Growth Hub, in case you're new to it. We're a fully funded business support service providing advice, coaching, webinars and signposting to SMEs. Our mission is to help you recover, adapt and develop sustainable growth after COVID and become more productive and profitable. All businesses at any stage of their development can access and benefit from the Growth Hub services, including online support through the Information Bank, Resource Network and the Helpline. Additionally, there is specialist growth advice targeted at businesses operating within some of our key sectors. This is a free personal service for businesses associated with Enterprise M3, which aims to connect businesses with experts to help with their growth plans. Before we dive in, if you have any questions during the presentation, please can I ask you to type it into the Q&A chat box in your Zoom control panel, and we'll try and answer them as we go. We will also have time for questions at the end. So now, without further ado, today we're here to explore the SME funding landscape. And on that note, I'd like to introduce our guests. So big welcome to you today, Cheryl and Bradley from the FSC Group. So hi Cheryl, could you introduce yourself and the subject of today's webinar, please?
Yeah, absolutely. Lovely to be invited this morning. My name's Cheryl. I work for the FSE Group. We provide funding solutions for businesses in the areas of London, the Midlands, the South East, Cornwall and the East of England. So I head up our southern area, which looks after businesses and comes under the Thames Valley Local Enterprise Partnership, Enterprise M3 Partnership and Coaster Capital. So I've been with FSE now for 6.5 years. My background is from Barclays and NatWest Business Banking. So we pride ourselves on looking after businesses and supporting them with investment and loans for high growth businesses. The aim today of the webinar is to help and support you with the COVID pandemic. It's been quite confusing, I think, and the idea is to give a sort of clear landscape on what funding is available to you and your business. So I'm really looking forward to talking to you all today and happy to answer any questions. Good morning. Sorry, I should have. Please, I am joined by my colleague Bradley, who works on the equity side. So I will hand over to Bradley to introduce himself as well.
Yes, hi, Bradley Jones. Obviously work in the equity team here at FSC. So we kind of, I suppose, follow the same mantra as, I suppose, what Cheryl has just said. But I mean, I suppose a bit of my background. I originally started at FSC in 2010. Worked there for 7 years in the equity team, raising a number of the equity investment funds and managing those, doing about 35 investments when I was there. And then I left, went to Grant Thornton, the large accountancy firm, worked in their corporate finance team, working on raising growth stage funding rounds for a number of technology businesses, and then also worked on some sale M&A mandates. And then I rejoined FSC in July maybe, to look after the equity portfolio that we have here, and drive forward a lot of their progress towards exits, which is what I suppose the end result of what everyone here potentially is looking for.
Thank you. So can you share us a little bit more about the FSC Group itself, and how it can support businesses?
Absolutely. We support businesses. We provide debt and equity funding across the different regions. This is from £25,000 up to 2 million, depending on the geographical location of the business. So our funds are market gap funds. So we typically sit after sort of things like the startup loan, friends and family, and maybe before sort of bank funding. So they are for high growth businesses that are looking to grow their business. I think the key difference with us is that we're looking forward. So we're looking at people's projections and what they're looking to do with their business. So high growth businesses. We work with a number of stakeholders. So as I've already mentioned, EM3, LEP, Thames Valley LEP, the British Business Bank, Funding London. So different funds across all the different regions. We have over 55 staff in the business, and most of the fund managers or investment managers come from a investment or banking background. So there's many years of experience in the business, too many to count, and people don't like me doing that. So many years experience of dealing with SMEs in this area. We're a socially responsible company, so we are a community interest company, and at the current moment we have invested and lent £80 million to 550 businesses. So it gives you an idea of the kind of businesses that we've helped.
Yeah, that's amazing. So just Cheryl, there you mentioned kind of growth and SMEs. What kind of things do your clients usually use the funds for?
Well, these are looked at on an individual basis. So it's, as I say, it's high growth businesses that are looking to expand. So it's everything really from a new contract or a new client to maybe staff, marketing, advertising campaigns, can be business premises, purchasing new equipment, exporting abroad, and entering new markets. So it's a real range of options available, particularly just, as I say, we're looking for businesses that are looking to grow. So any areas of growth, we can help support that.
It's fantastic.
Shall I jump in, I suppose, from the equity standpoint as well?
That would be brilliant. Thanks, Bradley.
Entirely different. But I suppose really from an equity investor's perspective, what we're looking for is really to invest into those businesses that are going to create the tools to really scale their business in the future. So whether that's, I suppose, building out the existing product offering or investing into sales and marketing to really boost that business forward. And I suppose from an equity perspective at FSC, we could do typically investments from anything from £100,000 right through to some of the larger funds can do up to £1.5 million. But really where we sit is that stage where a number of your larger venture capital firms, they have extended where they want to invest into businesses. So they really look for £1 million worth of revenue that the business has generated in the previous year. Then they would look to invest, which they've kind of moved up the scale. And then you had angel investors who were down at the lower end, that essentially businesses couldn't access funding to be able to get to that stage where they could be attractive to a venture capital investor. So we really fill that gap to really help the business drive forward to going out for venture capital funding in 18 months, 2 years after we invest. And then because we, I suppose, have invested in so many businesses, that we've got the contacts at those venture capital funds to be able to introduce them, get them excited by a business, and then they know that we're good at selecting very good companies, so they're keen to kind of look at what's in our portfolio.
Oh, that's really good. It's nice to be able to help them on that journey and that process, isn't it? It's good.
Thank you. So having seen, obviously, for the last 6-7 months with COVID, have you seen that kind of current funding landscape change over that period, Cheryl?
It's changed significantly over the last 6 months. What we're finding from our existing customers and speaking to new businesses is obviously there's new facilities come out from the government with C bills and B bills and the Future Fund. We are seeing lots of our clients looking at their existing banks to apply for C bills and B bills. So, you know, I have some statistics here. In the southeast where we're based, 175,000 businesses have applied for a bounce back loan, which has been approved at 5.2 billion. And 9,000 businesses in the southeast have had a CBILS loan at 2.1 billion. So some interesting statistics there. But as I say, we've seen a lot of customers that are looking at those facilities. What that actually means for businesses also in the area is that the banks themselves maybe are focusing on their existing customers and getting those government funds out the door. So people are looking at alternative ways of funding their business. There has been obviously LEP funding, which is what we're talking about today. So different local enterprise partnerships have different facilities on their websites. We've seen an increase from the startup loan company. There has been people that maybe come out of working in companies and looking to start up their own business. So we've seen quite a few people applying for startup loan company facilities. And then there has been some grants out there to support businesses as well. So there's been a real sort of mix of things. But I think people are still looking where they can get that alternative funding. What we have seen an increase on as well is people using the business platform. So things like Alternative Business Funding Platform and Swoop Finance and the British Business Bank to source different funders that are available to them. You know, businesses are in the fortunate position they have a lot of choice, but it's just about understanding what is the right finance for your business and what is the right funder to go with. So there are, as I say, a lot of those platforms out there that give you, you know, you can put in your details and what you're looking to get for investments or loans, and that will link you through to different funders that are available to you. One thing that I have noticed though is, you know, there is still online availability to apply for funding, but more and more we're hearing that, especially over the last 6 months, people want to find a funder that they can really talk to and have a conversation with and have a relationship with. So that's been something that's been very important to our clients. I think in difficult times, it's nice to have an actual relationship with somebody that you can speak to and talk to about your business and, you know, any challenges that you've got or what you're looking to do and how you're looking to grow. So it has changed quite dramatically in the last 6 months. We know that CBILS and BBILS is coming to an end at the end of November. We foresee that there may be some existing, you know, there's some other opportunities or other things coming out from the government, but we don't know what they are yet. So there is sort of a demand, obviously, to get those applications in. But as I say, there's lots still available for businesses out there. I can pass over to Bradley that can talk about a little bit about the sort of equity side and maybe a little bit about the future fund as well.
Yeah, certainly. So I suppose there's been a kind of not a fundamental shift, but there's been a shift, I suppose, in terms of equity investment over the last 3 years anyway, prior to COVID, which has seen, I suppose, the difference in what types of businesses are getting funded and where they actually are. So valuations, I suppose, of businesses over the since 2016, it was seen that they were quite toppy, let's say, in terms of valuations. And over the last 3 years, they've really begun to come down and not to a fundamental level, but making sure that those businesses are shifting away from that piece of, you know, the age-old, well, Google got funded with $50 million before it even had a business model. That's a thing that doesn't unfortunately happen that much anymore. Really, it's investing into businesses that can potentially stand on their own 2 feet in the future and not just relying on a big firm to come and buy them out. But so there's been a kind of fundamental shift in terms of valuations and matching them up to what an acquirer would potentially want to buy. Another piece, I suppose, that we've seen as well, especially in the, I suppose, venture capital market, is they're really looking for businesses that have been in the past very capital efficient. So every pound that they've spent, making sure that it's gone in to the right places. They've tried and tested it previously, and you know, they know what works quickly and they know what doesn't work quickly. So really making sure, so a lot of them have actually looked and said, we'll only invest into a business that has if they've raised, let's say, £1 million worth of investment previously, we want them to be on £1 million worth of revenue. That's what we're seeing. I suppose they're going along the lines of what Theo Paphitis always used to say of this is what you're going to do. Are you going to spend my children's inheritance efficiently? And really, that's what they're looking for. They want to make sure that the management are spending every single pound in the business on growing it as efficiently as possible. So it's one piece to really watch out for. But I mean, generally, in terms of equity investment in the UK, there's actually never been as many funds in terms of actual cash out there ready for investment. So I suppose one piece as a statistic is venture capital trusts, which is part of how venture capital funds raise their investment to invest into the businesses. In 2017 and 18, those VCTs in the UK raised 542 million to invest in that year. And the last tax year, so 2018 to 2019, VCTs raised 731 million. So it's really a lot of investors are looking at, I suppose this is investors into the funds. They're looking at something different other than getting their 0.001 that certain banks will give you as a savings rate. They're looking at putting their money into some venture capital funds that can invest into something slightly different. And really, there's been a lot of money put in there. So there is quite a lot of investment, but it's still tough to get into. You can't just walk in and they will give it to you. They're really kind of very keen in terms of understanding where the business is, what the plans are for the future, and where this is going to go. I suppose where a lot of those equity funds in general have done over COVID, for the first 3 weeks of lockdown, a lot of them panicked and really looked after their existing portfolio. No one really knew what was going to happen. Still today, no one really knows when things are fully going to open up again. But there's been a kind of quite a shift now that a lot of them are looking to really make investments into good businesses that can potentially hold out to the COVID storm, but then also really flourish in the future. So there's quite a lot of those investors out there are really interested in seeing new opportunities. Mm-hmm. And I suppose finally, in terms of the majority of early stage equity investment goes into technology businesses as a whole. And I suppose at the other end where exits are being achieved, the percentage of businesses that are being sold that are technology businesses has gone up something like from 20% before lockdown to about 45% now. So a lot of those larger corporates are looking at buying technology businesses to really see how they can fundamentally shift what they're doing as a business to make it much more efficient. And as a consequence, a lot of investors are really keen to see a number of technology investments.
Mm. Oh, it's really interesting to see that kind of shift, obviously from COVID, is that look of technology, isn't it, and digital, because we are all living in this kind of digital world now. Could I just ask Cheryl, what kind of guidance would you give an SME owner when looking to obtain finance for the first time? So obviously they need a handheld a little bit.
Absolutely. First of all, I would say clearly articulate your business plan and your experience, very much about the management team and who's involved with the business. When at FSE, we really look at the business, the service, the product, but most importantly, the management team and who's running that business. So I would say that, we look at the business, the management team, and we need the financials to back that up. But first and foremost, we're buying into those people. So if you've got people in the business that have experience, make sure you get their experience into that business plan, incorporate their CVs, incorporate whether they've run projects like this before, and all that detail. Then also, what is your product and service? So Try and keep away from jargon when you're looking at your business plan. So you're explaining to someone that maybe we've touched upon technology businesses. Not everybody would understand the technology. So if you are trying to explain your business plan and your business or your service or your product, then please, try and articulate that. Maybe a video would help. We've seen that quite often in business plans, that a video tends to help people explain very, very quickly and understand very quickly what that business does. So demonstrate your industry knowledge. So have a look at the industry that you're looking to go into and your business, and maybe look at a SWOT analysis for that industry and that business. So look at the strengths, obviously the opportunities, but also look at the risks of the business and how you may mitigate these. So we all know there's risks within businesses and certain industries. So rather than avoid those in a business plan, talk about the risks, talk about how you're going to mitigate those, or maybe what your plan B is. A lot of the businesses that we've seen in the last 6 months that have been successful and come out hopefully the other side of COVID are people that have been very aware of the risks in the industry they're in, and been able to sort of look at their business quite quickly and diversify if needed, or make changes within the business as quickly as possible. Look at the financials, have up-to-date financials, and look at your forecasts and your business plan. So get some help with these as well. If it's not your forte, then please do get some help. We're talking today obviously with Enterprise M3, and there are growth hubs out there. There are people that can support you. So there's lots of webinars like this, and there's also lots of events that people can go to. But look to people at the growth hubs that can support you. If you need some help putting that business plan together and those financials together, then get some support with that. But be realistic with your financials. So we have seen businesses that have come to us maybe, and they think that they are going to be more successful with funding if they put a lower amount in their business plan. But if you need to be realistic, if you need further funding, it's it can be just as detrimental to a business not to lend enough than to lend too much. So we want people to be realistic and look at that business plan, and look at their cash flow. So be clear about what the funding is for. So if it's for staff or if it's marketing, how are you going to achieve your forecast? So if make sure you're looking at those in detail, but be clear about what the funding's for. So people can advise you, because we've had businesses where if the business, it may be better for the business to look at asset finance if they're trying to finance some assets within the business. If they're trying to finance a particular project, it may be better to look at short-term funding. So the more detail you put into your business plan about what the funding is for and what you're trying to achieve, then that helps the people that you're talking to give you some advice on the best ways to look at that. But yeah, as I say, sorry, I was just sort of reading some of the questions coming up. I'm looking forward to answering some of these questions. But it's, as I say, just, make sure you get all the details in there, but get some support with that. Some of the best businesses we have seen are absolutely brilliant at running their business, have a brilliant management team, but they've never put a set of forecasts together, or they've never put a business plan together. So if you need support to get that information over to a funder, then do actually get that support and talk to them, and make sure you let them know that you're working on those areas. Bradley, you probably want to cover off a little bit about investor readiness for the equity side.
Yeah, so I suppose in terms of what, I suppose some of the areas of what an investor really is kind of looking for. I think one of the key areas is product market fit. So proving you've got existing customers and that they're really achieving value from using your solution. Often we've seen a number of businesses that have got some really great initial contracts for a year, but they sometimes don't speak to the customer beyond that once it's been, whether it's a technology piece that's been installed, or even down to, craft brewers who have put beer into a pub. It's really about making sure that those customers are really seeing the value. So the next year, they can really begin to identify what are the areas they're adding value to, and how can potentially you as a business help them further, which for everyone is going to be better. And I think one of the other bits, I suppose, is from an investor, what they're really looking for, there's, as I said earlier, there's a number of investors out there with cash, but really, how can that investor add anything more than just the cash? So do they have any, a lot of these investors have invested into tens or hundreds of businesses in the past. They know what some of the pitfalls are. They've got some really good experienced non-executive directors that sit behind them, or financial directors that they know if the business at some point is looking at getting a full-time financial director, having someone that your investors trust as well. So really getting as much information from the funder as to what they're going to bring beyond the cash is really important for both you and them. And I think, as Cheryl said, the being realistic with the financial projections is really key. I mean, I've seen so many businesses that go from having, I don't know, let's pluck a number, £100,000 in turnover 1 year, and then in year 3 they're doing, I have seen one that was £250 million in investments in revenue. And one, I suppose, statistic to look at is one of the fastest growing businesses in the world last year, which was Revolut. Over the last 5 years, they've not only, but they've achieved 354% year-on-year revenue growth. So if you're saying that your business is going to do 1,000% revenue growth over 5 years, then I think you might have to have a rethink about what you've really put in those projections, because there's so many fundamentals that sit behind that of when will the business run out of cash, and if the investor, the worst thing you can do is raise an investment round from an investor and then 3 months later they turn up at a board meeting, or you have to call them and say, I've spent all your money, can I have some more, because we didn't make as much revenue as we thought we were going to. So it's really key to make sure that you're really covered from that perspective. I think another piece is really looking into the competition. Have seen a number of businesses that say, I have no competition. That often to an investor screams that either you've created something that actually no one wants, or you really haven't looked into your market, because you're always going to have competitors out there. And I would also say, try to avoid speaking poorly of your competitors. It's good to kind of identify them in a certain niche of a market, and this is how you're different. Because if you go in and say everyone else is rubbish and my solution's absolutely amazing, the question comes of, well, why hasn't everyone bought your product? So you wouldn't be in this position of wanting to raise money. So I think really looking into that competition and where you sit. And then I think also don't forget the area of how that, from an equity investment standpoint, how that investor is going to get out of the business. Really, what are your, as a founder, what are your aspirations over the few years? Are you building this business? I've had some of, I'm building this business because I'd like my son to take over it or my daughter to take over it. I did have one that said that, and their daughter was 4 at the time. And the majority of an equity investment is investing into the management team, and a 4-year-old, we don't really know what they're going to turn out to like. So really looking at what potentially is your exit route. So you want to sell into a large corporate, or is there a private equity fund that's specialized in buying businesses in your area, or is it potentially listing the business on a stock exchange? But really thinking about where that potentially could come from. And the majority of exits that happen from, I suppose, a trade buyer buying your business is the business already has a relationship with that corporate, and they're doing some work with them that really the corporate turns around. And we've had it in the past that they're spending millions of pounds a year with you, and then suddenly, why are we doing that? Let's just buy the business. It doesn't make sense for us to keep on doing that. So that's quite a kind of fundamental area of what a funder is really looking for.
Oh, that's really good. I think we've got some questions, haven't we, Roya, in our little Q&A box there?
We do. So if we start going through some of the questions, bear with me, because there's some in Q&A and some in chat. So I'm going to start off with Simon's, which I think was the first one. So who are the investors behind the VCs? What rate of return are they seeking and terms? And is there a lot of cash around? If there is a lot of cash around, who has it and what is the source? I'm going to throw that over to you both.
I suppose shall I answer that? So I suppose investors into venture capital funds, there's 3 or 4 main types. A lot of it comes from pension funds. So a lot of actually local council pension funds put money into a lot of venture capital funds. One is a good example is the Church of England's pension fund put money into a venture capital fund a number of years ago. That venture capital fund invested into Wonga, and there was a big press release about that. The fact that the church didn't want people taking Wonga loans because they thought it was a bad idea, to then find out that their own pensions had invested into Wonga. So there was a bit of a difficult time about that. But so there's a lot of kind of pension funds that put money into them. Some corporates do that as well, invest into these funds. So even Microsoft have their own venture capital fund that they invest into earlier stage into businesses to then potentially look at acquiring them in the future. There's individuals who put money into venture capital funds, and they typically do that through that venture capital trust structure. So they get a tax relief for each pound that they put in. And then there's also in the UK, the British Business Bank that put money into a venture capital fund. So a lot of them will raise, let's say if they're raising a £100 million fund, they've got 50 million from some pension funds and some corporates and some individuals. And then the British Business Bank would say, we like what types of businesses you're going to invest into. We'll double that money up. So we'll give you another 50 million to match alongside that. So in terms of what they're all looking for in a return, the investors in those funds, it's really depends on where they're investing, what types of funds they're investing into. Some of them are very cautious. There are a couple of venture capital funds that invest into, there's one that invests into crematoriums, which is slightly strange business, but actually very stable type of business. But then there's ones that obviously do pure technology, which is a lot riskier. But there's such an array of what they're looking for in terms of outputs. But typically, the investors into VC funds are putting their money away for 10 years. So they invest their money in 2020, and then they wouldn't expect any money back until 2030. So they've got quite a long range. But where the venture capital funds themselves are looking for a return from an investor, from an investment, I would say, it ranges anything from 3 times their money. So if they're investing $1 million, they'd want 3 million back at the end, right up to earlier stage investors who are typically looking for 5 to 10 times their investment. That's not to say every business they invest into is going to achieve that, but they need to be investing into businesses that potentially can achieve that.
Okay, thanks. One of the, it's more a statement really from James, was that we found that many lenders are now only lending to companies who've got accounts or existing relationships with them. I did reply because I was presuming that it was particularly around CBILS and bounce back, that could be on a wider point. Around the fact that certainly the feedback we've had is that a lot of the top 4 banks, that is very much what they're doing, and if you want to go elsewhere you need to look elsewhere. So I will get back to you separately from this, James, on the list of potential lenders, but I thought it was worth throwing this over from your experiences as well, that is certainly what we're hearing actually a lot from businesses.
Absolutely, Roy.
Challenge as well, actually, because of you know, just waiting time, having to wait because and not being accepted sometimes.
We have seen that the there was one of the big 4 that was looking at new customers, but they stopped doing that now just to look at their existing customers. I know that the British Business Bank is looking at putting more lenders on, so we are accredited ourselves, FSE, for CBILS, but only in the Midlands and the London teams. So there has been a focus on trying to get more lenders accredited, because the main banks, as I say, just looking at their existing customers. So I mean, the advice I'd give on that is if you are dealing with your bank, try and get everything together in one sort of email or one folder so that you can send it over, because our experience, having spoken to existing customers, is that when they've got all the sort of business plan or their financials or their forecasts all together, it's been a quicker decision, because it, rather than drip feeding the information to the bank manager. But please do keep an eye on the British Business Bank website, because there are accredited funders that are being added on there every single week, and then that will give you details of whether they're willing to take just new or existing clients. So just do keep an eye on that. It is being updated every single week with new funders on there.
Yeah, thank you for that. Another question, so around technology investments and strategic fit and buying out and competitive threats, is that something that will enable one to get R&D tax credits? So the key aspect is cash flow. Can your customers actually pay you? The investor, in particular VC, can and are likely to take control of your business and make asset strip it. So I think there's a couple of points there actually around so within the technology kind of sphere, around preparing for investment, around accessing R&D, and at the same time, particularly as you were saying, that businesses have to go that extra mile within the present landscape for investors. Is there more of a risk as well from the business side, actually, for them to take more control of the business? I hope I've put that question across properly, son.
Yeah, so I mean, I suppose in terms of I'm not a tax expert in terms of the R&D tax credits and whether a company buying a business to be able to generate tax credits. I'm not sure whether you can do that, but I think in terms of I want to say it's a misconception that just because of everyone thinks a venture capitalist is a vulture capitalist. I very much say in the UK that is certainly not the case. All of these funds have, let's say, 30 companies in their portfolio. If they're coming in to try and kick out management teams and run them themselves, I think you all know that running a business, one business yourself, is very time consuming. A venture capitalist doesn't have the time to be doing that, of kicking out a management team and asset stripping a business. That's not really what they're there for. In the UK, they're investing into a management team because they believe that they're the best people to take this business forward. They're the experts in that space. And really part of the process of them investing is you showing them that you're an expert in your chosen market, and you know what the trends that are changing. So I'd really say, I suppose, taking businesses, VCs generally they're not looking to asset strip, because actually on the majority, VC-backed companies don't have any assets to strip. So it just doesn't really work like that. But I suppose in terms of technology investments, depends what, and whether it's a strategic threat, a strategic fit, or buying out competitive threats. Specifically within the UK, some venture capital trust money can't be used to buy out other businesses. So that would preclude some of them from buying out competitive threat companies. But then there are really a few. So like, as I said earlier, Microsoft has a Microsoft Ventures. Google did have one in the UK. But really the idea behind those was they could see what trends were coming down the road. They couldn't afford to put a whole team onto developing one new bit of technology, that they really thought, well, there are experts out there who want to create their own businesses that are doing things really exciting in that space. Will invest into those businesses to really, with that kind of seed capital, to see where they go, and try and get as much learning from that process, to then look at acquiring the business in the future.
Thank you. We've got quite a few questions, so I'm going to try and see as many that we can kind of get through by 11. So this is Tamara, thank you. So we're being told that post-COVID and after the government loan schemes have ended, funders will be very much tightening up their appetite for two reasons. So firstly, we're seeing to accommodate the potential of bad debt that's going to follow with CBIL and BBL. But also underwriting models will change. We should expect a lot more sector-specific credit policies rather than the normal 3 or so, and new ones for hospitality, travel and leisure, logistics, etc. So some of those key sectors that have been massively affected. Localised behaviours, demographic footfall on that specific business, in-depth recovery plans, EBITDA, DSC ratios increasing. Is this something you and your investors will be using more? With so much decision automation and algorithm-based lending, your gap in the market should attract strong businesses that have traded out.
I'll just pick up on that from the debt side, if that's okay. Our appetite hasn't changed the whole way through COVID. We have been very much open for business, for high growth businesses that are looking to expand. We generally ask for 3 years forecast from a business. All we are doing is we are sensor checking those forecasts. If somebody has taken government funding, obviously that would generally kick in to start being repaid in a year's time. So we are sensitizing those forecasts to make sure that, you know, they've incorporated those loan repayments back to the government there. I go on a lot of calls with the various different banks, and I haven't seen anything at the moment about appetites changing. Some banks have been saying recently that they're back open for new business because, as you can imagine, there has been a hold on new business because they've been concentrating on their existing customers and being able to get the government support out there. I can only comment on about how we make lending decisions within FSC. I do see there being more opportunity for funders like ourselves, particularly from the relationship side. I think businesses are enjoying and looking for a relationship so that they've got somebody to speak to. We make our lending decisions on our fund managers ask for a business plan and they ask for 3 years forecast. We then spend a great deal of time analysing those forecasts, analysing that business plan. We then write a report to our credit or our investment committee, and none of our lending is based on computers or algorithms or anything like that. It's based on humans writing a report and then presenting that to a credit or investment committee, which is a group of individuals sitting around a table looking to support that business and how we can help them. We see no reason why that would change, and we, as I say, we are very much open to business. So I can't, as I say, comment on the banks and things like that, but I can just say that we see no reason for our appetite not to change. And we have recently, in the last 8 months, lent also into the leisure industry and the events management sector and things like that. So obviously we are keeping very close to our clients to make sure we can support them, and if that needs to be things like capital repayment holidays and things like that, then so be it. But that's how we make our lending decisions. So hopefully that answers part of the question. Bradley, I don't know if you want to pick up anything about the sort of investment appetite from your side.
No, I think, as I said earlier, but a number of investors are still out there with essentially cash in their pockets. That's their eventual investors are saying, we want you to invest into these businesses, so get on and do it. I think where a lot of people have made money over the last 5 years, they started that from a seed back before, during the credit crisis. So actually a lot of investors are looking at it from that perspective, that there are some really good businesses out there that are capital efficient, that can really make the most out of the next 10 years, and that will be the returns in their funds. So certainly there's no kind of particular slowdown. There are a few certain funds that aren't investing just because they've either too heavily invested into pubs and coffee houses, etc., who are struggling. But yes, I'd certainly say there's still a lot out there investing.
Thank you. Comments here that, and certainly we've seen that AI and big data techniques are being used more. Interesting that you were saying from the FSE perspective, still very much the human piece is a big part of that. So it'd be interesting to see how that moves forward, not just with FSE, but generally within the funding arena. Just moving on, there's another point around which we might have covered off, around going back actually to CBIL lending, and the fact that it is very much based, quite rightly from what we've heard, on 2019 revenues and not necessarily using those 2020 or 21 forecasts, particularly for startup or pre-startup businesses. British Business Bank says that lenders can. We do also know that lenders tend to be quite variable about what they will accept and what they won't. So are there any lenders that do lend-based forecasting based on forecasts? Apologies, I'm trying to read and ask and think and ask a question at the same time. Not something I'm very good at.
Are there any lenders that just base their lending decisions on forecasts? Was that the...
No, we will accept. So rather than looking back, where there is a business that actually they're going to look for funding based on a forecast because they're at that early stage, are there lenders that that would do that? We have got tomorrow afterwards, actually, I'm just thinking it might be worth reading tomorrow's comment. We're placing new businesses with Lloyds, Barclays, and NatWest is a bit more tricky for owner trading businesses as well as commercial investment. Customers do not bank with them and not being asked to switch. We're not having any knockbacks except if it's around affordability, etc. But they have an open door for us anyway. So great. So that's some of the big banks that are actually looking at new businesses as well. Any other thoughts from your side on that specific question?
With regards to different funders, we're seeing a lot of people, as I touched upon earlier, looking at these sort of things like Swoop and the alternative business funding platform that links you to lenders that are specifically looking at if it's forecast driven or if it's historic information. All of our lending is based on forecasts. So FSE, that's where the kind of market gap comes in. So we are interested in people's historic information, management accounts and annual accounts, but we base all our decisions on the forecast of the business. So we almost draw a line in the sand there. So I'm happy to, we're going to give details of email and mobile numbers at the end, but if anybody's got any specific questions, I'm happy to cover those off. What we do pride ourselves on at FSE is if we can't help, if it's not something we can look at, then we can normally signpost people to other funders that may be able to support them. We have quite a big network, but I would suggest that I think, the funding platforms like Swoop and alternative business funding are very, very useful. Swoop in particular, you put quite a lot of information in there and it gives you quite sort of targeted lenders that will look at the proposition. I think that's quite helpful because from my experience, and I know from Bradley's experience, when people are looking for investment and looking for funding, it can take the management team out of the business for quite a long time dealing with that. So it's good that if you can sort of tailor 3 or 4 lenders that might be able to look at the proposition. So I would suggest looking at those platforms, but if anybody's got any specific questions or anything, I'd be happy to speak to them after this.
Thank you. Are pension funds moving their resources from established PLC securities to VCs?
I can't say whether they are specifically moving it from it, but I'd hope we all understand, and I should hope that all pension funds are diversifying their portfolio anyway, so they shouldn't all just have it into listed companies. This is it's a generally known piece from pension funds is they invest a certain amount of money into listed businesses, some into larger funds, some into venture capital funds. It's just it's I suppose spreading the risk. So there's not any news that I know of that they're all moving their I really hope they're not moving all of their money out of listed companies and into venture capital funds because they're very risky in comparison to a listed company. So,
thank you. And I think at the moment it looks like our final question, moving across. So back to a specific FSC question aimed at Bradley. Bradley, what's your usual investment size? So minimum and maximum.
So our minimum is about 100,000. But how we invest is we typically want other investors to be investing alongside us. So typically a funding round would be of £200,000. So what we're investing 100,000, and there might be a few business angels who are investing 100,000. We're happy to kind of look at that and get involved, right through to in our average investment size is about 200,000 to 250,000, but we do have certain funds that are in that we can do up to 1.5 million in certain areas.
Thank you. And I might be just worth reading out actually a final comment from Simon. So evaluate risk from both sides, absolutely. And established listed companies are struggling investing. So therefore, I was going to say investing into new startups and VCs may be difficult. So yeah, I mean, certainly from what we're talking to businesses, it's been quite a challenging time, particularly for some of those startup businesses in the tech sectors that we're working with. So thank you very much for that. I think unless we have any further questions, then I think we are going to wrap up. Caroline?
Yeah, so obviously just for everyone, we are recording this session, so it will be made available to you just to watch back and kind of go through those things. If there are any kind of further questions, ask us, ask the team here at the Growth Hub as well, and also Cheryl and Bradley as well. So thank you everyone for joining us today, and thank you to Cheryl and Bradley for joining us as well. It's been really valuable. Is there anything else you kind of want to add just before we wrap up?
Thank you for inviting us this morning. It's been really enjoyable. And yes, email addresses and mobile numbers will be available after. So please, if there's any direct questions or you'd just like to make contact, we'd love to hear from you. So thank you very much.
Thank you very much to everyone, and Cheryl and Bradley. If you'd like some more information, as everyone has said, please contact us directly or go onto the website enterprisem3growthhub.co.uk, and look forward to seeing you next time. Thank you.
Thank
Goodbye.
you.
Thanks everyone. Have a great day.
Thank you.
Thanks.